Chairman Whitfield, Congressman Rush, members of the subcommittee, thank you for the opportunity to be here today to discuss the history of the U.S. ban on crude oil exports and to contrast the market conditions at the time of the ban with those today. The U.S. Energy Information Administration, EIA, is a statistical and analytical agency at the Department of Energy. By law, EIA's data analyses and forecasts are independent of approval by any other officer or employee of the U.S. government. So the views expressed here should not be construed as representing those of the Department of Energy or any other federal agency. At the time of the passage of the Energy Policy and Conservation Act in 1975, U.S. net imports of petroleum were rising rapidly due to declining domestic production, while growth in consumption was rocketing up. U.S. net oil imports more than doubled between 1970 and 78, from 3.2 to 8.6 million barrels per day, driving imports as a share of total consumption from 22% to 47%. Internationally, when OPEC declared an oil embargo against the United States in 1973, 65% of rising U.S. crude oil imports were coming from OPEC countries. To protect consumers from price shocks, the U.S. policy response at the time was to limit the price for oil produced from U.S. wells existing in 1972 while allowing new oil to sell at world market prices. Limiting exports prevented circumvention of these domestic price controls. However, the separation of new and old oil pricing did not really stem the production declines as oil production in the lower 48 states fell some 23% between 1973 and 1980. By 1981, it was clear that the policy wasn't working and the price and allocation controls were removed. That's on figure 2 of my testimony. For nearly 3 decades after the removal of price controls, declining production coupled with rising demand pushed the U.S. towards ever-increasing imports until net imports as a share of total U.S. petroleum consumption peaked at 60% in 2005. Restrictions on crude oil exports remained in place, but limited modifications from time to time allowed exports to Canada, exports of production from Alaska that went through the Trans-Alaska Pipeline, and certain California heavy crude oil. Since 2008, however, these conditions have been reversed, partly as a result of the growth in domestic supply and also as a result of slowing demand. U.S. domestic crude oil production has increased by 3.4 million barrels a day, some 68% to its highest level since 1986. Meanwhile, between 2008 and 2014, this year, we're estimating for the full year, total U.S. liquid fuel consumption fell from 19.5 million barrels a day to 18.9 million barrels a day. The U.S. went from being the world's largest net importer to becoming a big exporter, net exporter of petroleum products. In 2014, net imports as a share of total U.S. petroleum consumption is now down to below 30%, close to 25%. The dramatic production growth in the U.S. mid-continent and Canada has resulted in logistical constraints that are reflected in a wide variation of prices for domestically produced crudes. In 2008, benchmark crude, West Texas Intermediate, or WTI, sold for a premium of $2.73, a premium higher than Brent that comes from the North Sea. In 2014 through October, WTI has been trading at a discount of over $6 a barrel to Brent crude oil. EIA's latest short-term energy outlook forecasts recent trends in U.S. petroleum markets will continue into 2015, with domestic crude oil production averaging 9.4 million barrels a day, 10% above the 2014 level. Gasoline demand and net imports as a share of domestic consumption could be 21%, as recent dramatic declines in crude prices may affect our outlook, but more so, I think, in the longer term rather than in the very short term. So petroleum market conditions today are very different than they were in the 1970s when the ban on crude oil exports was enacted. Key trends in U.S. oil markets have reversed. Then demand was rising rapidly and production was falling. Now production is rising rapidly and demand is falling. U.S. crude production may soon hit an all-time high. surpassing the previous record set in 1970. Gasoline demand is down from its peak and is likely to decline even more as the vehicle fleet becomes more efficient. In addition to this trend reversal, international oil production is less concentrated. OPEC's share of production is down from 53% in 1973 to about 35% today. The existence of oil contracts on the futures markets, the development of benchmark crude oil pricing, and the availability of basic data from EIA, created by Congress in 1977, have all brought greater transparency to the oil markets. As described in my written statement, EIA is actively pursuing a number of important initiatives related to the timeliness and detail of oil market data. I'd like to thank you for the opportunity to testify here today, and I hope to be able to answer your questions. Thank you.